Anand, it's been a smart recovery to say the least. 8-10 days ago, there was a bit of a mid-air turbulence. Chins were down, momentum had broken. We were hit by money moving from India to China. Everybody was trying to reconcile with victory of Donald Trump and what it meant for the world. And if that was not enough, you had a big sell-off in Adani group of stocks. Despite the odds being against us, markets have made a decent comeback, Anand.
Yes, the market has obviously shown a lot of resilience, and in fact, I would argue that the correction that we had, which is now being kind of eaten away, is actually more a question of the earnings itself coming down, because after the second quarter earnings, the results, by and large, I think analysts will have to bring down estimates for the consumer sector, if not more, and that will overall bring down the EPS estimates for the year, which means that the correction is more or less aligned with just about the earnings downgrade that is likely to happen, which means the market is back to where it was to its previous stretched valuations. While it may be good for the market in terms of the fact that it shows that there is still a lot of belief in the system about where the market is headed, the reality is that I think the market is now running ahead of itself, has been for a while. But now, given the fact that we have evidence to show that there is a slowdown in the economy, you are perhaps even for now taking into account, kind of optimism that may not be warranted.
Right, okay, let's just take a short detour. And Indigo, it seems, has filed a lawsuit against Mahindra Electric Automobile over the use of 6E in its new electric vehicle, the BE6E, that is. Sumit is here to tell us more about this new corporate fight or India Inc. fight which is currently brewing. Sumit?
Well, Indigo has today filed a court case against Mahindra for using 6E. Well, in 2015, Indigo came up with the 6E call sign, which is it is using not just for call sign but for all the selling and marketing purposes. Now, Mahindra came up with an electric vehicle last week, calling it BE6E. So the fight is on this patented trademark thing, 6E. Now the case has been forwarded to on 6th of December. The further hearing will happen. However, sources are telling us that Mahindra has reached out to Indigo for some kind of patch-up. However, it is not clear whether they're agreeing to it or not. Well, both of the companies are of the view that 6E is their, well, Indigo is of the view that 6E is their patented brand name, so nobody or no company should be allowed to use this. So that's a particular thing on which Indigo has dragged Mahindra to court and has sued the company.
All about branding and brand recall, and 6E is something that Indigo stakes claim was their innovation. But let's try and understand why Granules India is one stock which has been in a bit of a free fall zone. Quite a bit of crack coming in on Granules. Not the 52-week chart, that won't be pertinent, but if we can just bring up the intraday chart today. The company, of course, had informed that US FDA has classified the inspection at its Hyderabad facility as an official action indicated. Let me take it across to Varun and find out what exactly transpired. And Varun, now I can see the stock is cracked 10.5%.
So it has cracked 10.5% because the company's Gagillapur facility has been, classified as official action indicated by US FDA. Let me remind that the inspection of this facility was taken over in the month of August and September, and in the month of September, actually US FDA has given Form 483 with 6 observations. The observations were related to cleaning, maintenance, inadequate root cause analysis, procedures, and on which the analysts were expecting that a company would come out with some remedy against these 6 observations. But now the unit has been classified as official action indicated. Now there is a problem. The company says that the company is working with US FDA to get all the clearance, but till now it looks like there is no respite for the company. This facility within itself is very important because it supports the global operations of Granules, and more than 50% of company's revenue comes from this facility. In fact, if you look at the overall formulation capacity, it is higher than other 3 facilities combined for this company. So this is the importance of this facility, and also this company supports the global operations, and it supports the company's finished dosage and pharmaceutical formulation intermediaries. Also in Q2, if you look, because of this pause, the company has to take a hit on its overall financials. So it was an important facility. Analysts were expecting that it would get clearance, but now if an official action indicated is given to this facility, then definitely it's not good for the company, and hence you're seeing after this news the stock is cracking because this facility contributes more than 50% of company's revenue.
Free fall and now hitting lower by 11%, and the fall is coming on big set of volumes as well. But before we take a short break, we at Times Network are back with our flagship event, India Economic Conclave, presented by IDFC First Bank, which has been the epicenter of igniting the right conversations pertaining to India's growth. The 10th edition of India Economic Conclave, through its aspirational theme, fast-tracked to the top 3, will be charting a roadmap on how India can accelerate its ascent to becoming the third largest economy in the world. IEC will feature the biggest policy makers, global voices, economists and corporate honchos. Tune in to the Times Network to witness all the action live on the 12th and 13th of December. The market, of course, is scaling up to the day's highs. There you go, the consolidated revenues for Swiggy. The first earnings reportage post its numbers. It's almost a 12% uptick on a sequential basis that they've seen 3,600 crore rupees in terms of their revenue. Brokerages were working with a figure of about 3562 thereabouts. So that looks like it's pretty much as per target. The consolidated loss has come in at 625 crore rupees, which is not much of an uptick on a sequential basis. What we were anticipating was, we were expecting a 476 kind of loss. So the loss hasn't really come down in that sense. And I guess that's what is acting a little bit on the stock right now, because remember, the stock went in strong into its earnings. Of course, would be curious to see whether there is what they deliver in terms of the quick commerce numbers, because that's where all the fight and the margin seem to be. We were expecting the GOV uptick of about almost 15% and the gross take rate at about 15.5%. Let's see what they deliver, because going by the profit, or rather here in this case the consolidated loss figure, that's definitely lower than what the market was anticipating, because the market was anticipating the loss to come in much lower than what they've actually reported, which is what is reacting sharply, I guess, on the numbers. Nikunj?
Aisha, I'll wait for ESOPs. I'll tell you why. Because when you look at those, there is a big, they've gone public. In that, how much at operating level, because when you charge for ESOP, it comes in the net number. So for me, I think the EBITDA number is important. For me, there are a lot of other ESOP adjustments which I expect, because they went public, so you don't know what ESOP policy they followed. You cannot jump into a conclusive, immediate conclusion looking at these numbers. They may not be that impressive. That is what the headline numbers are indicating. But is this largely because of ESOP, or there is an operational challenge there? Because these numbers in a sense are not going to have an impact on the stock per se, because markets are expecting that, okay, you've gone public and there would be series of events, series of surprises which will come from Swiggy. But if there is no ESOP and these are operationally subdued numbers, that means there is no marked recovery. Because if consolidated revenue is up 11% and if consolidated losses have gone up, so you're not expanding your losses, but you are also not contracting your losses, which is what Zomato did, which is what really got them this pedestal positioning. So I'll wait. I mean, I think we'll get 2 or 3 minutes.
The losses come in at 554 crore rupees, which is also flattish on a sequential basis.
There is no improvement, no, Aisha. So then we are saying that, look, whatever changes they've done, and ESOP is above EBITDA, is below EBITDA, so that means EBITDA is operational, which clearly means that there is no marked improvement in terms of the profitability. Now, is it quick commerce? Is it because there was a slowdown which happened largely in and around, what regions they've been servicing? I don't know yet, but these numbers will not really excite a lot of market men, considering that this is the first one from Swiggy where after the IPO, and on the heels of what Zomato has just done in terms of a capital raise. Anand, there was only Zomato, and now it is Swiggy and Zomato. And this good old comparison of who's better, which is a better franchise, I think this would be like a good old comparison which would be there for decades now.
So, I mean, I think the two of them have slightly different business models. So far, Swiggy is trying to be the single app for everything. Zomato has two different streams. There is also the fact that Zomato seems to have better execution at this stage. So Swiggy has a lot of catch up to do. And that will obviously mean that you cannot be worried about the profitability too much unless you are, while you are losing, unless you are able to establish a much higher market share and growth rate than Zomato is. So it is a catch-up problem for Swiggy. I mean, it's a fight between two fairly large companies now. And, it's a very tough business because your execution margins are not very high. Each transaction will cost you a lot to deliver, and yet you have to make money on it. So I think, if you really have to look at how it pans out, you have to give it a slightly longer time frame. It's only when it is listed you can begin to see the parameters that work. But for now, as you said, the preliminary numbers don't look all that exciting, at least as far as the operational profitability is concerned.
Anand, where have you been shopping in this market? I mean, this market did give a dip. To be fair, 10% plus on the index, 20% plus in mid cap, 30% plus in small cap.
Sorry, did you ask me where have I been shorting?
No, shopping in this market.
Okay. Well, I mean, frankly, the only place where valuations are somewhat comfortable has been the banking sector, and that to the private sector banks is what I've been focusing on. So I think that's been the obvious play. It continues to remain relatively better, and of course, the lower valuations has slowly moved away because HDFC is no longer as attractive as it was a while back. But even then, it has somewhat underperformed the market in terms of its growth. The other areas that are still have actually done badly have been insurance, for example. This year has not been a great year for insurance companies, and that remains to me one of the more attractive sectors in the financial space with a somewhat longish runway. The usual places which most people have been looking at, which has been the PSUs, defense, and the new technology companies. As I said, the new technology companies, I would rather wait to see how the execution goes through. I think there's too much euphoria perhaps in some of the new renewables. I still have to figure out where the value is. Obviously, the renewable installation players are something that one can look at. And, one has been doing some bit of that. But the utilities itself, the fact that they have gone at some humongous levels is something that baffles me because, the numbers that they will generate is not going to be anything exciting in terms of ROE. So there are, it's been a difficult call to figure out, where you are looking at, but largely it is to try and find places within the renewable space, within the defense space, which are slightly off from the main line.
Okay, some more nitty-gritties coming in from those Swiggy numbers. We, of course, have the quick commerce numbers there, and that's definitely seen a sequential uptick of 30%. But I guess what the street is not liking is this sizable investment that they're making in the logistics business. That's Scootsie Logistics, and that's a company which Swiggy long back had acquired. So I guess that is what is not going down well with the street. And you can see the Swiggy intraday graph, if we can just bring that stock, because it went in strong into its numbers. Post the first flash, it was up 1%. It had come off from the top of the day. Then it went up again about almost 2%, and now you're seeing it drift back into the red. We're going to have Snehi, who tracks this company closely, join in to get us more details about what exactly this new investment in the logistics business is, because I think that is what has got the street a little bit alarmed. Snehi, what more can you tell us about the numbers?
Well, absolutely. So overall, our first take on the numbers, it is looking quite weak coming in for Swiggy because you have revenue that's come in at 3,601 crores compared to 3,222 crores, which is up 11.8% on a sequential basis. Revenue is largely in line with what we were expecting. However, if you take a look at net loss, that has widened at 625.5 crores compared to 611 crores. We were expecting this amount to go down. It is significantly more than what we were estimating. This amount is be at 476.6 crores. Even EBITDA loss has come in at 554 crores compared to 544 crores on a sequential basis. We were expecting this number to be lesser on a sequential basis. However, this is widened, and we were expecting 462.5 crores. So it has beaten our estimate also in a much negative way because the loss has widened. Now, if you take a look at some other segmental performance, food delivery revenue has gone up by 3.9% sequentially. Out of home consumption revenue has come in at 59 crores, which is up roughly 29% on a sequential basis. So that's looking good. The quick commerce business revenue has come in at 490 crores compared to 374 crores, which is an uptick of 31% sequentially. Food delivery net profit has come in at 122 crores compared to 67.4%, which is up 81% on a sequential basis. So food delivery is looking good. However, you have quick commerce that has not performed very well in the quarter gone by, because you have the quick commerce net loss has also widened, coming in at 307.2 crore rupees compared to 280.2 crores on a sequential basis. Now, however, they have made some other announcements as well. They've invested equity shares of Scooty Logistics Private Limited up to an amount not exceeding 1600 crore rupees. So they've made an investment in their subsidiary of Scooty as well. Remember, this was one of their first acquisitions, and Scooty is their e-commerce branch. Also, they've incorporated a wholly owned subsidiary of the company for sports activities and amusement and recreation activities. So this subsidiary is also going to be catered to that. But if you take a look at the overall fine print, it's looking like a very weak set of numbers coming in for Swiggy for quarter 2.
Now, what do we have? We have a consolidated loss. The food delivery business, and Sneh, if you're there, I'm just trying to dissect the numbers here, Sneh. The food delivery business is profitable, which means the mainstay, which is the food delivery, they've managed to turn the corner there. The problem is that in the quick commerce business, which is the high growth business, which has re-rated Zomato because of their Blinkit acquisition, I think is in loss. And that's where they are burning. Because if the quick commerce revenue is up 30%, and if the losses are there, despite the fact that there is at EBITDA level, despite the fact that there is a profit in the food delivery business, that means you are losing money in quick commerce. And quick commerce is where competition will intensify. Quick commerce is where some of these companies now will have to face the heat of Flipkart and Tatas and everybody else. So imagine in the business where you're growing, you'll have to get ready to fight, and you don't have that kind of an ammunition, because you are now looking at investing 1,300 crores in another business, which could be an allied business called Swiggy Logistics. So this is where I think the sequence of event is something which is bothering market. 4 minutes to go. I'll turn my attention back to the markets now, because Swiggy and Zomato and Swiggy both, they remain the center of attraction from a curiosity standpoint and from a participation standpoint. What is catching my eye, however, is once again HDFC Bank. And Anand, for a stock which could do no wrong, it has had 3 years of hibernation. Has HDFC Bank gone through its painful share of 3-year consolidation and is now getting ready for a giant leap?
Well, I don't know about giant, but clearly, this was a problem that you could not grow enough. And therefore, relatively, it was, underperforming its peers, which were growing fast enough, because of the fact that they did not have, their credit deposit ratio was way out of whack. It has been corrected, but I think the period of slow growth will still continue for a while. The only thing is, relatively now it doesn't look so bad, because the overall credit growth itself in the industry has come down to 13%. So from something which was roaring at almost 50% higher than that, it has now come down, and that will mean that HDFC can continue to mildly underperform rather than strongly underperform in terms of business performance. On the loan side, for the rest of the bank, there has not been much of a problem, and therefore, if you assume that their credit deposit ratio gets corrected over the next, let's say, 6 months or so, you should assume that it will become back to business as usual. It should be trading, therefore, at a premium to the rest of the industry, which currently it is not. And consequently, I think you should expect steady growth from HDFC going forward. I would hesitate to put a number on it, because it also depends on where the economy is headed. But broadly, I think it should remain part of your core portfolio.
Okay, getting set then for the market close. I don't know if we still have Vaishali there, if we can get a take on where the market is actually headed from here. But we've done ourselves pretty okay. We are closing in at the high point of the day. About a 0.5% uptick is what we're shutting shop the day with. So it's looking pretty good right now. The Adani names have made a very solid comeback. Look at Adani Ports, that shot up about almost 5.25% right now in trade. Adani Enterprises is also holding up a good 2% in trade as well. But Anand, good to have you on the show.
If you like this video, then like, share and subscribe to ET Now.